So we've got a full agenda today with some great, helpful updates. So, say it again. So we'll go ahead and get started with our first presentation, which is going to be Joycelyn and Ellen talking a little bit about our legislative and regulatory updates. Thank you very much.
Switch it up today. I'm going to go first and Ellen's going to go second. So, brief update on the bills from 2017. Wanted to let you know that our technical housekeeping bill was signed, and so that will go into effect January 1st, 2018. And then the other bill that we were closely tracking was AB 20 on the Dakota Access Pipeline on engagement reporting for our interactions with the companies that are owning or constructing the Dakota Access Pipeline. So that's less up your alley, but I wanted to let you know. No, not at all? Oh, I totally feel like I'm echoing. There we go. That's funny. Okay, I'll start over. Sure. Joycelyn Martinez-Wade, I'm Director of Governmental Relations. So to give you an update on bills from 2017 that weren't held up in the process, that actually got signed by the governor, our technical housekeeping bill did get signed, and the AB 20 Dakota Access Pipeline engagement reporting. So that's more on the investment side. But that's the update on those. The housekeeping bill goes into effect January 1st, 2018, and we had reviewed the various provisions that have more of an impact on employers at earlier meetings. And I do want to go ahead into the proposals that we're looking at for next year. The Teachers Retirement Board had its meetings last week, and on Friday they decided on 4 proposals to go ahead and sponsor. Some of them you've heard about before, and some of them will be slightly new. Some of them have less of an impact on you. So I would just want to go over those now. You don't have any written materials on them, but the board items are available on CalSTRS.com if you go to the Teachers Retirement Board and look at the agenda for their November meeting. You can pull up those proposal analyses that did go to the board. And then just to let you know, timing-wise, before I get into the actual content of the proposals, is that the bill introduction deadline is February 16th. We'll be getting all the language together and seeking an author. So that is right before the February 21st EAC meeting. So we will have materials for you then. You can see what's in print. And of course, we can get feedback from you today. And then you also are always welcome to get in touch with me or my staff to ask any questions or give any comments. So the first proposal I'm going to go through is one that you have heard before, and it has to do with aligning contribution and reporting due dates. And so again, I think there was an early version you had heard about, maybe about a year ago. The update here with the proposal is that all of the contributions for both the defined benefit program and the cash balance benefit program would be due on the 6th working day after the pay period. So this is different than DB right now is 95% on the 5th and 100% by the 15th, and then cash balance is by the 10th. And then on the reporting side, we're looking at the 20th working day, and this is a change from right now. 45 or 44 calendar days is on the DB side when the reports are due. And so essentially the shift is almost like 30 calendar days, but it is 20 working days. And on the CB side, currently the law is 10 working days. So that is the basic shift there. And I'm going to go proposal by proposal, so I'll stop and get comments. We are looking at some administrative costs on this one for updating our accounting system. And because we're pushing back the due date from the 5th to the 6th, there are opportunity costs that CalSTRS may take on. So, and it's between $140,000 and $420,000 depending on the investments. So that's the opportunity cost by allowing that extra day instead of the 5th, requiring the 6th for the 95% of the contributions. So questions on that one, comments? I'm going to grab my notepad. So it looks like Vina has a question or comment.
On this one, about the 6th working day, it's very hard for us to issue the right amount of money by the 6th working day. By the time we get our report, we balance, we get the charter school information. So is STRS going to remove the penalties and interest?
That is not in the proposal.
It's not?
No, it's not in the proposal.
So then can you add that?
So I don't think that that was part of the plan, but I appreciate the question.
Because it's not going to be possible when we have the adjustments going back after we get done. So we are pushed to give the money by 6th and then penalized for making adjustments on the following payroll for the previous cycle.
Mm-hmm.
I just wanted to bring that to your attention.
Thank you very much, yes. Anybody else? Okay.
Sheila Walker, Tama County Office of Ed. If I'm understanding this correctly on the report, it's a 20th working day. That makes it due a different day every month. We're really struggling just to make the current date, so I'm opposed to changing the reporting date at all.
Thank you.
Anyone else have?
So with the change in, Faith, Marty Kroger, San Mateo County, is with the requirement to pay the full amount on the 6th working day, in order to avoid penalties and interest, we're thinking that we'll just pay whatever we collected in payroll. And oftentimes the adjustments that are made are really credit adjustments to, the report. So if we pay a higher amount than the report that's submitted, what happens to that credit balance that results?
So right now, I believe what happens if we get more money than we would actually need based on once we get the report and we can align the two, then we just return those funds to the district or to the employer.
It would be a check issued back to the county?
Or electronic funds transfer, or however that's handled, yes.
Okay, so there wouldn't be a settling up with the subsequent report?
Is there anyone settling up in the subsequent pay period? Like a credit issued? No, we'd return the funds. Okay, so we would refund that amount, so per file.
Okay,
If we
thank
had
you.
more than was actually needed, we would refund that amount.
Oh, on the same thought process, as if we pay what ran through payroll on the 6th, by the 20th, we've got our file ready, and oops, we were off a little bit, and we owe another $35. Would we be able to make that extra $35 as soon as we know the exact amount on just a subsequent payment on the same file, in order to avoid whatever P&I would incur if we just waited and added that $35, and that would be associated with a different file anyway. So ability to make multiple payments, even though you're saying it's all due by the 6th, if when we reconcile our file, we owe more, we're ready to pay that balance due right away.
If it's
How do we make another payment on that same file?
right. So if it's the money would be due the 6th, anything that's late would have a penalty associated with that. If it's an adjustment to something you had submitted, so if a line changes, I guess, by that amount, then you'd have the 60 days to make that adjustment.
Okay,
But if
not
we
having
hadn't
an
received
adjustment.
anything at all, then it would be late and there is a penalty for that.
So right now, we would still be able to make that full balance due. We're going to pay what's on payroll, but oops, we forgot something, it didn't come through on the payroll. We see it by the time we submit our report, and it results in an additional $35 that we owe in contributions. Can we make that second payment and associate it with the file?
It's associated with the file, but the cash didn't make it in the door by the 6th, so the cash would be late. Unless it was an adjustment to a line, that somebody didn't get paid enough money or something like that.
But you won't have the line until we make the payment or the report on the 20th, so you won't even have the report.
Right, but it's still, the cash was supposed to be in the door by the 6th. So that's, yeah, so how it works now. And that's essentially one of the reasons why we're looking for this is so that we can get the reports earlier so we can figure these things out on an earlier basis, because it is the lag time.
But it's just the ability to make an additional payment that will be associated with that one file.
So that actually doesn't happen now either, because you have the 5th or the 15th. We don't get the file till the 30th. Most employers are getting things in by the 30th, or until the 44th day after the pay period. So we would still be, if it's brand new information, then the contribution would be considered late after either the 5th or the 15th. So same thing after the 6th, that would be considered late.
It's just that right now you're expecting 2 payments for each file. I mean, that's typical.
Well before the report is due.
And right now you're expecting 1 payment and then a file, but chances are, unless payroll is really good and there's nothing changed, we're going to be looking at making possibly 2 payments each month anyway.
Okay.
Anna Lambert, Riverside County. So having to make the payment by the 6th workday of the month, most likely it will create a refund to us every single month that we report. In addition to having to pay for some of the employees who didn't, it may be most likely will be a refund every month. So every month we would expect to get a refund that now we have to work and give that money back to our districts on a monthly basis. And the other issue is sometimes when there's a variance of amount due, I think right now that the threshold is $10. If we owe you $10, no, it's in the contributions, you expect full 100% payment, right? The threshold is only on the penalties and interest?
So in that one, I'm not familiar with the variance threshold. So I don't know if there's anyone in the room that can answer that question.
I want to confirm this, but I believe with the contributions, right, there isn't a variance. We calculate what is due, and so if it's off by $5, we would calculate that part. The PNI, I think, is where there's the $10 threshold, but I can confirm that.
Thank you.
Other thing I wanted to ask is that, I know you don't like my suggestions, but is the 20 days reporting time, at least more than 2 days we lose to do the employer-approved edits. So is there something going to change in that area as well?
That's not planned right now, no. Not to the edit process.
Because we right now barely make it to that 20 days, but we lose a lot of time going through that process. Just wanted to bring it to your attention.
Thank you.
Hi, Tammy from Solano County. I just want to agree with everybody else that our 100% payment on the 6th will never, ever match the file we send to you, ever. So you will either be doing a refund every single month to us or doing an invoice to us every single month.
Okay.
And then for the STRS upload, are you guys is that file gonna process quicker? Because right now it can take hours to submit a test file to get our errors back.
And I don't have that information.
Because that delays the process too, to be able to finish clear our
okay.
errors, that it takes so long for your system to process the reports.
Hi, I'm Catherine from Sutter County Schools. And 2 things about the 6th working day, 100%. I agree, it would never be the right amount, so the reconciliation would be a little bit of a nightmarish for you. But additionally, if we have to do the ACH, we have to get that to our auditor treasurer like 3 days prior to them wiring the money. So that means that we have to actually know that number before we've even entered all of our time cards for us and for our districts. We literally wouldn't know what that number is 3 days prior, 3rd working day. And so it would be actually impossible for us to know what that 100% is. Additionally, sometimes mistakes are made and supplemental pays are run. Timesheets are missed at our districts and us, so we might have to run a supplemental pay, which would need to be reported to that prior month and included in that report. Well, now we've missed our mark even more. And that's not uncommon to have to run, a couple of supplemental pays. I know that the larger county offices, they're running 3, 4, 5, 6, 10 payrolls a month. How could they possibly know what that second and third and fourth payroll is going to be to include it in that 100% payment? It's actually impossible.
Got it.
Hi, Renee from Napa County. I also want to point out we have offline districts that don't get their data to us until after they've run payroll and after they've retrieved their data. So I'm not getting, at best, their data until the 2nd, and if it falls over the weekend, then maybe even later than that. And I also have to have my payment set up with the auditor and treasurer 2 days prior to the payment date. So yeah, it's impossible. Impossible.
Okay. Thank you.
Ramona Coker, Stanislaus COE. Not to sound negative, but it appears to me that the employers are being set up for failure strictly in order to receive additional money that CalSTRS would not be paying out because it wouldn't be in any calculation for final comp benefits. This is just additional money to help supplement CalSTRS. That's how it appears to me. Once again, trying not to sound negative but there's no way that the employer can do this.
Anybody else?
So I just want to thank everybody for the feedback. This is just the beginning of the legislative process, and that's exactly why we meet with you, to get this feedback and see what we need to do through that process to change it. So I appreciate hearing kind of on-the-ground comments about how this would work in practice. And, I would say our intent is really to sort of standardize the reporting and contributions, but understanding that we wanted to reach out to all of you and hear what would the implications be, and I think we're starting to hear that. So if there's other comments, great, but I think in the interest of time, we should go on to, and it looks like you have another one? Okay, we should move on to the other proposals as well.
Sure, and I'll underscore what Grant's saying. We really appreciate hearing from you because in terms of, what options we have and how practical the proposal is, we need to understand what, we're looking for operational consistency and we don't want to do it at your expense. So this is helpful feedback.
Yes, agreed. Okay.
Sorry, this is Cindy from Butte College. And another consideration is that some of us have not payroll that happens at the end of the month, but on the 10th. And so if you back that up, we have to have payroll done 2 days before that. But then if you back that up 2 more days for your auditor, then again, like somebody said, you have to have the number before you have the number. So you're looking at adjustments on every single payroll that comes in. I'm not sure what the percentage of refunds and billings that you do now, but it's going to be close to 100%.
Okay. Thank you.
Also, the timing happens to coincide with a new system and a new format that we're going to have to try to figure out and implement. So that kind of puts an added struggle to the employer.
Right. Understood. Yeah. One more? Okay, then there's 3 more proposals to go through, so.
Hi, Renee from Napa County. I just have a question. What is the difference if we're paying 95% now, currently, by the 5th, than getting 100% by the 6th?
The difference on,
Why is the 5% difference? Why are you guys pushing this?
so it's a matter of trying to align the due dates, as Andrew and Grant were saying, and have those coincide so that it's simpler to have everything all on the same date. So I think that's it. And technically, we take that cost, what is it called? The opportunity cost actually hits on the CalSTRS side with that scooting back the day, since it gives an extra day for the 95%.
I would like to welcome you guys to come sit with me at my desk and let you guys see exactly the struggle that we currently have with the dates and the due dates, and let you see how it's really impossible of what that 6th day is asking.
Okay. Okay. I think I have to move on to the next proposal. We were slated for 15 minutes, and I think I've already taken up like half an hour. I'm not sure. But I appreciate all the feedback. Like Grant and Andrew both said, this is exactly what we wanted to hear, to see where you're coming from. So I appreciate it, and thank you all for sharing. And I'm going to move on to one that I feel like is related to something some of you were talking about, working with your assessors, your treasurers in your counties. And another proposal is to require electronic funds transfers of contributions. And I heard CalPERS giving some updates this morning. So we know that theirs has gone into place. They have a waiver system. We're looking at kind of reflecting the same way that they're doing that, requiring the EFT, having a process where you could potentially get a waiver if that's something you can't do. It would also be on the timing of the board, so the board would decide when to pull the trigger on that, similar to CalPERS. I think their bill passed back in 2009. Obviously, they've taken some time to get ready for the implementation, so we would anticipate doing the same thing. So questions on that one or comments on EFT payments? Okay, thank you. And then this next one you had heard about in the past as well, for excess sick leave, which I know you're all familiar with. It gets billed at the end of an employee's career right now. You may or may not have granted the excess sick leave. If you didn't know, oftentimes the employer gets billed many years down the line, interest is charged, things like that. So we were looking at, and I think this was initially met with positive reactions, so I look forward to seeing what you have to say today about having annual billing of excess sick leave. And so this would mean that if an employer is offering excess sick leave, they would pay in that year for that employee's excess sick leave. And we're looking at this also, the trigger being pulled by the board, because this is something that would have to be done in the new system in Pension Solution as it gets programmed, because we need to have the automation there for that. And we would be looking at the cost being approximately 0.2 to 0.3% of a member's credible compensation for each day of excess sick leave. So 0.2 to 0.3%. And that takes into account excess sick leave that's already out there. So if we made this transition on January 1st, 2019, we would stop the billing at the end of the career and just start billing annually. So it has to take into account any excess sick leave that's already been granted, and obviously going forward, what would be granted. So I think that's more specificity than we had before, but so I wanted to bring that up.
Lori Benetti, Chabot Las Positas. How would STRS know what to bill the colleges or the school districts?
So I think part of the file specs as we go forward in implementing changes as part of Pension Solution, we'll be looking at tracking sick leave and requesting that information. So then we would, and as you're reporting that to us, and we would have to rely on the employers to say, okay, these different employees are getting this many extra days of excess sick leave, and then we would get the information, and I believe the idea would be to send an invoice with the charge of whatever the rate is per day.
Our employees earn it by the hour, and so their hours are different every month that they're paid. So we don't know when we've got 400 employees, 600 employees getting excess sick leave, that difference every single month. So
Okay,
that would be our problem.
right. And I think there are complications at the community college level because of how sick leave is granted and excess sick leave is granted.
You know, the downside of doing this, because I agree that the LEA that grants the excess sick leave should pay for the cost, but on the flip side, I think something to consider is that if the member ends up using their sick leave, this has added a cost to us that we normally wouldn't incur. And so it's just giving us even more burden financially. It could very well be that on that, that last year that administrator uses that, 20 days of excess sick leave, and now my little school has already paid for it unnecessarily. So it's just another added cost to the LEA. Could be, potentially could be.
Thank you.
Oh, sorry. Jenny from Yosemite Community College District. Would you allow for tracking within STRS? Are you going to allow the employer to see where their excess leave balances and liability lies as we go through the year?
So I'm not sure that I understand the question.
Okay, you're going to bill us for it annually, correct? And as you receive information, can the employer track where they're standing on that liability?
I think, so if you're offering 3 excess sick leave days, we would be notified of that, and I think we would take 3 days.
Well, we're a community
times.
college, so
Okay.
we're in that group that has an issue with the fact of we
Okay.
accrue it as it is earned. So, and right now we're billed for it and paid for it as the person retires, which is fine and adequate. But if you're going to do that throughout the year and they use it and therefore it's not even part of liability anymore, like what kind of tracking mechanisms are you going to allow for the employer to have to determine to pay that liability at the end of the year? We have to be able to track that and be able to pay that liability.
I don't know if anyone has that already figured out on our side, or we can look. I appreciate you bringing that to our attention, because I do understand, again, that the sick leave accrues differently. Of course.
I think that if it's used and there isn't.
Can you introduce yourself?
Sorry, John Meredith Simkowick from Governmental Relations. So I think that the cost would be actuarially determined, and so if people use it, then the rates will go down. So if there isn't any of this stuff that's left at the end of a career, then the rates would go down ultimately. So I mean, I think it's all spread. I'm not an actuary.
But I think the issue is whether or not it gets tracked along the way, especially if it's granted in a manner that isn't maybe typical, or if it's hourly like it's been described for some community college districts.
Okay, I'm sorry, I misunderstood.
Okay, more on this one? Again, I appreciate bringing the complexities to our attention so that we can consider if there is a way to track throughout the year and how it would be handled, with the calculation of what's due through the file specs and what you submit to us, or if and definitely we need to think about community colleges and things that are accrued on an hourly basis or for overload and situations like that. So thank you. And the last one just is more of an FYI because it affects members once they've retired, but I want to make sure to let you know about it. It's a post-retirement option change. So when members retire or when they're eligible to retire, they can elect an option beneficiary to continue. They would receive their benefit and it would continue after they pass away. There are only 4 limited circumstances members can change their option in retirement. One of them is if they get divorced. And at that point, basically immediately when their option is canceled due to a divorce, they either have to pick a member-only benefit or select a new option beneficiary. And let's say they've picked the member-only benefit. A few years down the line, if they get remarried, they cannot choose their new spouse. So this proposal would allow that member who selected the member-only option to select their new spouse once they know they have one and they've been married. There are some time limitations around it to make sure that we avoid adverse selection, so the marriage would have to be a year long, and then there'd be a 12-month waiting period before it would take effect. So an additional way that our members can take care of their families. Yeah. questions on that one? And then Ellen's going to give a brief update on regulations, and then we'll get out of here to continue with the agenda.
Hello, everyone. I have a very brief regulatory update. We don't have any formal rulemaking activities going on in the regulations world, but we are doing something called a Section 100 change that we're planning to submit shortly to the OAL. And I wanted to share a little bit about that because it's not something that we've done a lot of in the past. Usually we do full formal rulemaking, so you see the notice getting posted online. Many of you are subscribed to receive email notifications. And then the changes are posted for a 45-day public comment period. Section 100 changes are different because they're only very narrowly usable when we're doing changes that are changes without regulatory effect. So we're going through that process, and I just wanted to share that with you. It relates to the file specifications, and we'll post the results of that online if it's approved by the Office of Administrative Law. We have another communications plan as well that member account services will be executing. I think there will be information out on SO and things like that. But what we're doing with the file specs, or aiming to do, is because they're over 200 pages of error messages, troubleshooting, their presence in the regulations right now clarifies the information that we need to administer the system. But a lot of the information that's actually in the file specs, and the file specs are their own kind of mini law book because they're fully incorporated by reference. A lot of the information in there really isn't a regulation. It's, like I said, troubleshooting tips, error messages. So we're trying to pull out a lot of those contents that aren't appropriate to be in regulations, with the end result being that our regulations will be a lot thinner. And when we do make changes to the file specs that are related to the project going forward, when we do add additional fields, it's going to be a lot easier for hopefully the public to review, and also the governmental agencies that we work with, like Finance, Office of Administrative Law. So that's what we're working towards, and it's a little different from the way we've done it in the past. So if you have any questions, just contact regulations@calstrs.com. And that was my update. Does anyone have any questions?
Well, this goes back to a little bit about the proposals and the legislative session that will be coming up. And among those 4 items, there was nothing about any possibility of change to how the excess contribution returns are handled. And there have been, I think, from the very beginning, there have been feedback from the employer side that we would like to see that changed, and our response has been, it's in regulation, we can't change it. I would like to personally, on behalf of employers, suggest that something go forward, or at least the possibility discussed to change the way that the excess contribution refunds are handled. We're fine as an employer receiving the employer parts back, but we would strongly recommend a change be at least requested or proposed that would allow the employee member contributions remain in their DBS account. It's their money, it's staying in DBS. They'll eventually get it. I don't know why it has to come back through employers now.
We've definitely heard you, and like you said, it's in the law, and it's something that, went through, it was a lot of, obviously, conversations on the funding plan with the governor's office, with the legislature, and with the different advocates for different stakeholders. And that was the way that it was decided that it should go forward. And so I think that a change to that would have to be driven by those parties. And so the advocates, so whether it be the teachers groups or the employers and the different business official groups out there. So I think that's who would have to drive that, who drove that decision in the first place. It could be finance brings it up. A legislator may want to take that on, but I think that's something that we saw decided on. We understand the difficulty, and that there might be some ease in keeping member contributions in DBS. We have let advocate groups know that this has been a concern that's come up, so we try to mention it, and that might be something they want to pursue. Something that's interesting that I think comes up once we bring it up is that there are many creative ways that people are coming up with about how those funds could be used and where they could be placed. So no one has exactly said, oh yes, keep it all in DBS. I think sometimes they're looking for member choice. Like, do they want it to come back to them? Do they want it to stay in DBS? Do they want it to go to a different kind of defined contribution plan? So interestingly, in saying that this is a difficulty, then what sounds a bit more complex to me, ideas come up after that, so.
Well, I was just hoping that, you mentioned all these other groups that could send something forward. I guess as an employer, I don't feel like I have a voice other than to let CalSTRS know this doesn't work well for the employers. We would like for you to make it right, to take it through as a sponsored proposal.
I think that those kind of changes have to be sponsored by a different organization. So I think that's where my response comes from. Anything else on regulations or on the ledge front? Okay. Thank you very much.
All right, thank you, Joycelyn. Thank you, Ellen. And next we have the item, an update on the Pension Solution Project. And let me know if I have this right, Bill Frericks?
Yeah, that's me.
Okay, thank you.
Hi, everyone. I'm Mike McCloskey. I'm on the employer readiness team. Unfortunately, Bill could not be here this afternoon. I'm going to give you guys a brief pension solution update. And most of you may have heard it if you tuned into the Teacher Retirement Board meeting. First off, the functional rollout is scheduled to be implemented no earlier than fall of 2018. The project schedules and tasks are currently under a 90-day review, which began in September 1st, and it will be wrapping up in December. Based on this review, a new schedule will be developed during the month of December, and we'll give you guys the results of this effort as they become known. And as a result, Employer Readiness has canceled the employer meetings until this effort is completed. As with any large technology project, unexpected challenges are common, and CalSTRS is doing its due diligence to make sure that we reduce risk and ensure a successful project. For more information, you guys can reference the Teacher Retirement Board materials on calstrs.com. And lastly, concerns raised by the employer forum regarding the contribution reporting process in the new pension system are still being discussed within STRS. We'll share the outcome of those discussions when we have more information, and the discussions remain ongoing. And that's all I have for you. Any questions? Awesome, thank you.
I guess that puts us back on track. Yeah. All right, so next topic we have is Gatsby Standards 74 and 75. I always call you Banky, but Bankole?
Banky.
Banky, all right.
From our financial services.
Yep.
Right.
Oh, good afternoon, everybody. So the last two topics, or at least the one before that, was very exciting. So I'll try to keep this accounting stuff pretty exciting. So my name is Bankole Fatunla. I go by Banky. I'm the financial reporting manager here at CalSTRS. And today I'll be going through talking about the impacts of Gatsby. Sorry, Dina. Do I just keep going? There we go. All right. So I'm talking about the impacts of Gatsby 74 and 75 on CalSTRS and employers. So in 2005, the Gatsby, the Governmental Accounting Standards Board, issued 2 new standards relating to other post-employment benefits. Those are benefits, post-employment benefits other than pensions. So we're talking about healthcare, post-employment healthcare benefits, disability, life insurance, those type of things. And so there are 2 statements that were issued. One was 74, which impacts CalSTRS, and 75, which impacts you as employers, as well as CalSTRS employers. So 74, it establishes new financial reporting standards for local government OPEB plans. So we as CalSTRS administer one of our plans is the Medicare Premium Payment Program, and this is what this standard relates to. It applies to us where it puts some requirements on us to report new amounts, and it also the other side of it is Gatsby 75, which applies to you guys as employers. It requires you to have new reporting on these post-retirement benefits. So I was going to go through what the plan is, the MPP plan is, and kind of give you a background, as some of you may be familiar with it, some of you may not be. But the OPEB plan that CalSTRS administers is the Medicare Premium Payment Program, or MPP program. And what this does is that for any eligible DB member, it pays the Medicare premiums for those members that are eligible and that don't qualify for Medicare premium free. So as you know, when you turn 65, you qualify for Medicare, but you have to work for at least pay the Medicare tax for about 10 years. And prior to a certain point in the past, teachers didn't have to pay this tax, but I think after 1986, teachers were required to pay this tax. So because of that, there's certain people, for one reason or another, who may not have the necessary 40 credits that Medicare requires for you to get the Medicare Part A premiums free, or without paying a premium. So CalSTRS offers its benefits to those that qualify to receive, for us to pay their premiums on their behalf. The program also pays for their Part A and B late enrollment surcharges. So if you don't enroll by 65, you're required to pay about a 10% surcharge. So the eligibility for the program is pretty complex. It's based on the dates of retirement. So it's a closed program, so only members that were retired before July 1st, 2012 qualify for this program. So it doesn't have any new entrants. The number of retired members who may be currently eligible, but have not yet enrolled is indeterminable, because it's hard to tell. We don't have the information to know how many people actually qualify for premium-free Medicare or not. So you could qualify through your spouse, you could qualify through other means, but it's hard to tell. So that's one of the wrinkles about this plan, is that number is indeterminable. But for new entrants, for people that are recently retired, they are no longer eligible for this program. Another thing to note is that it's funded on a pay-as-you-go basis. So why the change? So this change is similar to when they issue the standards for pensions, 67 and 68. The overall purpose of these standards is to divorce funding from financial reporting. In the past, the standards that were in place before were more focused on funding, like how much of the pension liability was funded. And really, that's different from the requirements for accounting purposes. And so these standards were put in place to separate those two. And so the biggest change that you'll see is that the new standards require us to actually record a liability, or calculate a liability, a new measure called the total pension liability, total OPEB liability. So similar to 67, which required the plan to calculate what the total pension liability is, or the net pension liability, and it also required the employers, you as employers, to record a portion of your pension liability on your balance sheet. This does the same thing for OPEB benefits. So in the past, you didn't have to, there was a measure that was calculated called the, I'll just give you the abbreviation, you don't need the full one. It's a UAAL. It's a It's a mouthful, so I'll just keep it at the abbreviation. But it only required you to calculate that and disclose that in your financial statements, in your notes. You didn't actually have to put it or record anything in your system or in your balance sheet. But now this will require you to record a new liability for the net OPEB liability. One thing to note, it'll also require you to report OPEB expense. So similar to 67 and 68, you have to record your pension liability as well as the OPEB pension expense. It also requires more extensive disclosures, so there are new disclosures that the standard will require. So just to give you, kind of show you, so this is an OPEB liability as of 6/30/2017. So Gatsby 74, we as CalSTRS, we as the plan have actually implemented this standard. What impacts you is 75, which will be implemented in the current fiscal year. So that's fiscal year 17-18. So when you look at the number, this is the collective liability. This is the liability that covers, all employers, all 1,700 employers. So what is required is to record your portion of this. So even though it's, when you look at it in comparison to the pension amount, it's relatively small. This is $420 million versus the pension liability, which was $92.5 billion as of 6/30/17. So it's a very relatively small number for the plan as a whole, for the retirement system as a whole. So as I stated, it requires employers to report a proportionate share of the Medicare premium program's net OPEB liability and OPEB expense. You also have to record your deferred inflows and deferred outflows. So essentially, these things that were usually just put in your footnotes and you disclose them, didn't have an impact on your balance sheet, will now have an impact on your balance sheet and your income statement. So what are we doing to help you with this? So in implementing this, CalSTRS will be, we have developed 2 new schedules of proportionate share. And some other reports and some other information that will help your employers to implement this standard and have the information you need to make the journal entries and things that, and record the balances that you need to record to comply with these standards. The first is a schedule of proportionate share of contributions for employers. This schedule is essentially the schedule of proportionate shares you may be familiar with, but it excludes the state. So it's just the employers. The other schedule that we will be providing is the premium and surcharges paid for employers. So it's, we pretty much, we allocate the total premiums paid as part of the program to employers. Now, for this schedule, the allocation is based on the last employer of record. So whoever the member doesn't have to, the employer doesn't determine if the member opts into the program or not. If the member is participating in the program and we're paying their premiums on their behalf or for them, when we prepare this schedule, those the expense or the liability or that portion of the payments that relates to their last employer of record is what's reflected in that schedule. Now, one thing to note is that we provide these 2 schedules to aid you. We're not recommending one or the other. The decision on what you use is totally up to the employer. We also provide other schedules. One that we provide is the schedule of, we actually have a report called Other Post-Employment Benefits Information Report, which provides other things that you need. It provides one schedule called the Schedule of Aggregate Other Post-Employment Benefit, Post-Employment Amounts. And what this schedule does is that it gives you all the other information that you need, like the collective deferred inflows and outflows, as well as some information that will aid you in calculating what your OPEB expense is. The report also has some information that you need for the footnote disclosures, including the discount rate and all these other pieces of information that employers need to implement the standard. So I'm just going to go through and show you examples of the new schedules. So the first year is contributions for employers. So similar to the SBS, the Schedule of Proportionate Shares of Contributions that you might be used to, it has each employer by reporting unit and their proportionate share, and their proportionate share. And this is based, again, on contributions. This next schedule is the Schedule of Proportionate Shares of premiums and surcharges paid for employers. And it does the same thing. It shows each employer's proportionate share of the total premiums and surcharges paid. Now, one thing to note is that this wouldn't include all employers. The former schedule would include all employers. This would only include employers that actually have members that are retired from those employers that are participating in the program. This last schedule is a schedule of other post-employment benefit amounts. And again, this shows you all the different, this has a different information that you need to book certain, to calculate your OPEB expense. So it shows some of the changes in assumptions and some other items like the deferred inflows and outflows that you need to record your proportionate share of. So one other thing that we'll be doing is as we implement the standards, before the end of the fiscal year, we'll be reaching out and doing some outreach and providing resources and information to further aid employers in implementing the standards. Similar to 67, the implementation of Gatsby 67 and 68 will also have resource materials, including these schedules I mentioned, which will be available on our website. So the key takeaway is the Gatsby 75 will add new reporting requirements. So there'll be new disclosures, new balances to record, and that we as CalSTRS will assist in providing information you need to implement this new standard. So with that said, do you have any questions or comments regarding this? Thank you very much.
Thank you. Thanks, Benki. Since we have a little extra time, I wanted to, I think most of you were here for the last Employer Advisory Committee and heard from Peter Haley. That was his last meeting, and he has now sailed joyfully into retirement. And I just wanted to let you know that we have appointed a new director of member account services with whom most of you are familiar. That's Christine Briseño. So she's going to come up and just say a few words about her vision for the business.
Can everybody hear me? I'm not necessary for me to be on. But thank you, Andrew and Grant, for just a few minutes to just say hello and formally hello. I have been acting in the role for about 18 months, and I've really enjoyed working with many of you and learning about how we serve you. And I just wanted to say that we are going to continue that effort to try to meet your needs through what's going to be some very challenging years to come. As you heard earlier today, we are doing sort of a soft pause on the project to try to reevaluate how we're going to implement and how we can ensure that we're going to meet your needs specifically, since of course you are our first rollout. And so I just wanted to say that we're going to be doing this thoughtfully. You have many, many very talented staff who are advocating for you at the table as we're looking at what improvements that we can make and what that schedule might look like. Also, we very much appreciate all of your thoughts and words on the ledge proposals, because our staff that serve you feel very strongly as well to make sure that whatever changes we make, you have a loud voice in whatever is ultimately passed. So thank you for that. And as you probably are familiar with, your staff, your employer services representatives oftentimes try to come down so that they can meet you face to face. And so I just would like to ask those staff who are here to please stand, just so we can make sure that you know who some of those people are. They're most of the mic holders. Of course, I'll be available after if you have any questions, and I'm looking forward to working with all of you. And when we restart up those employer forums, there are an opportunity for your voice, for us to share with you what we're thinking about, and then, of course, to listen to you so that we can make as many adjustments as we can to try to have a very successful new system delivered for all of you. Okay? Thank you, Andrew.
Okay, so we are at that part of the forum where we can talk about things that you might want to hear about at the next Employer Advisory Committee. Comments and suggestions?
I have a comment or a question from for Gatsby 7475 from Andrea Miller, El Dorado County Office of Education. Why do we have a different due date for the money than the report? If they are not turned in at the same time, then the payment amount will change from when it was made and when the report was submitted.
That sounds like it's with one of the ledge proposals and not with the Gatsby question, but do we have somebody either from fiscal services or ledge people who can address that question? Maybe while Joycelyn gets up here, could you read that question one more time?
Why do we have a different due date for the money than the report? If they are not turned in at the same time, then the payment amount will change from when it was made and when the report is submitted.
It's been consistently that way in the law for a number of years, so I think it's about getting the money in the door so that we have that, and then the lengthier amount of time that the report comes in allows for any of the edits to be made, for the information to roll in, and so that's why they believe they were split up decades ago in the law.
Thank you. Are there any other questions online? How about in the room? Open forum?
Any specific topics that you'd like for us to address in the next Employer Advisory Committee? Mina, yes.
I would like in the next advisory meeting if we can go over these creditable compensation one more time with all the amendments at different time. So as of right now, a list of items.
Yes, we'd be happy to do that.
Thank you.
Hi, this is Carol again, and this just popped into my head, and it may be something that's so automatic it's being worked on, but I believe there was the topic with the new membership date, and we were told that's being worked on as far as when the forms are signed for permissive election. The right now membership date is the first of the month following, and there was already a process being discussed to potentially change that somehow to create some flexibility.
Okay.
So I didn't know if that would come up with the legislative things.
So I didn't mention that we will have our annual housekeeping bill, and we are working on the various proposals that are coming in, that have come into governmental relations, and I believe that's one of them, so we'll be working on that. So there'll be more details in February. And I did want to go back to the previous question, so I apologize for go back, but I think that the question that was received online is the intention of the proposal as well, is that you have the due date for the money being separate from the report, and so aligning all of them and moving them closer together is what we're looking to do with that proposal. Thanks.
Any other comments or suggestions? Yes, front row.
Homeowner Coker, Stanislaus COE. If the biggest focus is on aligning the money and the reporting, why can't we move the money to the reporting date rather than moving everything up? Why can't we push the money due out? That would make it easier for us.
Come on up, Joycelyn.
That increases the opportunity cost to the system. And as we mentioned, even with the 1 day, with pushing back the 95%, there could be an impact of $420,000. So anything that would push it back even further than that would have more of a cost impact to the system.
Any other comments or suggestions? One more.
Well, and conversely, this is Catherine from Sutter County Superintendent of Schools. Conversely, coming up with that extra 5% is impacting our interest earned as well. So not only are we having to come up with the wrong amount of money, potentially 15 days prior to when it's previously was due, we too are losing interest on that money. So again, it's on the backs of us with the increased rates. You know, we really are struggling, I think, statewide.
I think mathematically, because the 95% is the bulk of the contributions that come in, there's actually a slight benefit to the employers on that side of the cost factor. Yes, it moves up the 15 days, it moves up the 10 days for CB, but because, again, the bulk of the DB contributions come in on that 5th day, by pushing them back a day, there's a slight advantage to the employer.
How about we compromise and do 97%?
And actually, the law currently is, I believe, somewhat permissive on accepting the 5% after the 5th day. So, you know, in looking at that kind of detail as well in the statute. So I can bring that back, though, the 97%.
I suspect, this is Catherine again, I suspect that this isn't possible, but I wonder if STRS could offer a rebate or a discount if we could come up with that 100%, so that maybe the smaller county offices or the ones that only one payroll a month that are able to comply with that with that 6th working day, 100%, maybe they get some kind of a discount or some kind of a rebate. And then for us folks that's completely impossible, we would continue with the 95% and not get that rebate or discount.
Appreciate the suggestion. Because the contributions cover the benefits that are going to be paid, I don't know where the funding would come from to provide that sort of discount or rebate.
The other comment that I was trying to make is the education code allows to pay us, the employees, by 10th of the following month. For the October, pay by 10th of November. But now money is due by the 6th business day. So how can we pay the money even before the payday?
Thank you for pointing that out.
Mm-hmm. Okay, well, I'm not seeing any other comments or suggestions, so we'll go ahead and adjourn. Thank you.